and welcome to this very special edition where we try and analyze what really is going to be the course of equity markets in 2019. But if you do pause and take a rewind of how 2018 has been, you've got to pat yourself at the back. Given the kind of volatility and the carnage that was playing out across world markets, we've actually managed to outperform the rest of the world. With the Nifty still showing you positive returns of roughly about 3% and the Sensex managing a gain in excess of 5%. And this at a time when the S&P 500 index has seen a cut of 8%, and hold your horses, the market that we are most correlated with and taken comparison with, Shanghai Composite, that's lost 24.5%. So if you were to rewind 2018, what were the factors that really influenced the markets? You got to ask yourself. Brent, and that really kept us, all of us, on our toes. The fact that Brent actually hit that $80 per barrel mark, and since then you've seen a significant cool down, and 18% downtick coming in on a year-to-date basis. So that's really kept our boat afloat. Aside of that, the rupee as well has shown you significant amount of weakness, almost about 9%, and this has been amongst the worst emerging market currencies across the world. Not just that, this was a new one. Money got more expensive in 2018. The fact that Fed hiked rates 4 times in the year gone by, that was something that we were witnessing after many decades, literally. Also, Trump imposed tariff on Chinese imports, so there were heightened fears about a trade war emerging between China as well as the US, and that also kept equity markets across the globe really on their toes. Historic firsts, and you had Trump as well as Kim Jong-un meeting. This is really going to go down in history books, a first of its kind, but they finally called truce and shook hands on the sidelines of a summit in Singapore. Not just that, US has also reimposed sanctions on Iran, so that also took its toll on world markets. And back home as well, there was just so much news flow, right? Urjit Patel hung up his boots as the RBI governor before his term actually ended, 9 months before that actually. So that was another first that we were seeing. Not just that, you had massive scams as well. What with the PNB, which was actually hit by Nirav Modi, and Mehul Choksi fraud as well. So that also kept the news headlines abuzz. Aside of that, remember, this was also the first year that you had the long-term capital gains tax as well implemented. It was only last budget, which is in the month of February, that this got announced. So this was the first year when you paid taxes on your equity gains. Aside of that, this was also a year of big deals. You had Walmart buying stake in Flipkart for a mammoth $16 billion. Aside of that, we're almost stepping closer now to the 2019 elections. So you had some key state elections in 5 states recently, out of which this was a surprise really, with Congress actually winning in 3 states. So we had our hands full all of 2018, but the question now is, we managed to stay afloat, we've managed to outperform world markets. What next? Are we going to continue to face volatility? Are we going to fall in line with the rest of the globe? Or will 2019 be a year of consolidation? That's exactly what we're chatting about with our experts joining us on the show. Got on board with us Neelkan Mishra from Credit Suisse, as well as Amitabh Sonthalia joining in from SKS Capital. Gentlemen, evening. Amitabh, if I could start with you first, which cycle of the bull market do you think we're really in? Considering we managed to defend ourselves quite a fair bit all of 2018, still sitting on positive gains. What were the top highlights for you that impacted equity markets in the year gone by?
So 2018, as we know, has been a very difficult year for investors because most of the portfolios have underperformed. Most investors have done worse than the markets. Even though the frontline indices have done well, and we had a sort of a market peaking out beginning of middle of the year, most, I think, small cap indices and mid cap indices have peaked out early Jan, and since then has been on a declining trend. So I think the small cap index is down about 40% this year. And when I look at the chart patterns in 2018, I find it somewhat similar to 2008, at least for the broader market, whereas the as far as the broader market is concerned, in terms of the duration of the fall, as they say, history doesn't really repeat itself, but it certainly rhymes. So in that sense, we've had a year which is reminiscent of 2008 and 18 as well.
Right. Neelkan, I want to get you in on the discussion as well. Evening, firstly, where do you think 2019 has headed, or rather is headed, given the kind of context of how volatile and news-heavy all of 2018 has been?
There is clearly a change of, say, the regime, the prevalent consensus. There was a certain way in which we thought the world was moving from the time that China joined the WTO. The prevailing consensus was that it was about an open trade, a free world, increasing financial interconnectedness, and there's clearly those questions are being raised. So that generally means that there is higher risk aversion. You don't know what can happen in the next 1 year or 2 years or 3 years. That's the first thing. The second is that there was very unconventional and unprecedented monetary policy being followed by the developed world, the G3 and the Bank of England. This was the first year where the balance sheets started to contract. So in the next 12 months, there will be another about $430 billion that they shrink by. And in FY20, that is in the next 2 years, the total could be about $900 billion. So there is a So the world was used to, for a very long time, and that was part of the design, that you have very low interest rates, you have very easy financing, and that prevented much deeper problems post the North Atlantic financial crisis. But as the growth normalized, as the monetary conditions started to normalize as well, I think there has been quite a bit of adjustment. So there was a phase where every asset class was doing well because there was so much money available. Now we are starting to head towards a more normal environment. So I think on both these issues, the fact that there is a backlash against free trade, there is clearly conflict between the G2, which is not just economic now, and then this issue of tightening monetary conditions after almost a decade of a very easy policy. So there is bound to be disruption, and I don't think it's over yet. I think 2019 we will continue to see some of that.
Right. So in that light, Neelkan, would you say it's a little premature to be happy about us just about hitting that 11K mark? And the fact that crude has declined the way it has, it's already quoting at 17-month lows, purely because of the uncertainties that 2019 is also going to throw up at us.
Yeah, so see, the global growth is slowing, right? So I think the fall in oil price from say 83, 84 to maybe 67, 68 was perhaps supply driven. I think people were surprised by the exemptions given to China and India and a lot of other countries, that is the Iran sanctions. And then there was this Kurdish supply that came in, some of the transportation bottlenecks in the Permian Basin in the US came off. But the 68 to 58, I mean, initially, of course, it was just, I think, long positions being unwound because no one expected it to happen. But the last round of decline is actually a bit worrying because, see, if it is supply driven, it's actually win-win for everyone, right? I mean, other than, of course, the oil producers, but it means that demand is good, prices are low, what can go wrong? What the last $8–10 have actually been a bit worrying. Initially, it seemed technical, but what seems now is that growth is actually slowing down globally, and that's not a good sign. So low oil, of course, provides somewhat of a boost to domestic consumption, but it is not a very good sign for the global economy. So what this means is, and which is why you are seeing many of the global indices at 14-month lows, is that you need to have a lot of stress and volatility in the financial markets before the tightening bias. So, so if the consensus view and pretty much what the central banks have guided to has been of monetary tightening, that interest rates will go up in 2019 or expected to go up in 2019. If you have to change that trajectory, there needs to be some amount of financial stress, financial market stress, which will then trigger the central banks, and it's actually a game of chicken. You do not. Your objective is to manage the economy, not the markets. But then the markets, when they throw a fit, then sometimes it starts having an impact on the economy as well, and that the banks have to react to that. Which means that there will be a period of volatility, a lot of stress. This euphoria that we are seeing in India, we have to be very clear on what's driving it, right? So the first is that there are significant flows into the Indian equity markets, which is, I think, something that doesn't look like it's changing anytime soon. There are a very large number of small investors which are putting money in. This is classic herd behavior. It doesn't mean it'll stop. I mean, and if it keeps happening, so think about it this way. Reasonable years, actually good years in the past, we would see $20 billion coming in from foreign investors. We're getting $20 billion every year now, on a very steady pace from domestic investors. So there is quite a bit of buying pressure. If there is no real panic happening, people then wait for the expected bad news to play out and start buying again. These are, I would call, somewhat technical things. I think the economy in India is actually slowing, and I would be very careful on what I buy. See, the P multiples for the market are driven by much more macro issues, like, financial savings being routed to mutual funds, or global monetary policy changing, or the fact that bond yields in the US, which were at 3.2, 3.3 at one point and headed to 3.5, are now back to 2.8. So all of those issues do affect price to earnings multiples, but when it comes to choosing the sectors that we should be in, I think we have to be very careful.
Right, fair point. But Amitabh, what we've discussed up until now is the larger, the broader construct of 2018 versus how 2019 is going to be. While we can feel happy about the fact that 2018, if you look at the Nifty and Sensex level, it's still in the positive. But you and I know, if you look at individual portfolios, they're still very much bleeding. What about the selling that we've seen, and vicious at that, across the broader end of the market, the mid and small caps, and the fact that they're still lagging very much behind the large cap universe? Do you believe that broader markets as well have bottomed out, or do you think that we're bound to see more pain for the broader end of the market even stepping into 2019?
Yeah, so just like in 2008, the bulk of the fall was done in about 8 to 10 months by, say, October, November of 2008. And, again, seeing the similar chart pattern where, we see some signs of bottoming out in the broader market, the small and mid cap space, both technically and fundamentally. So I think we are yet to see a period of consolidation next 3 to 6 months, which probably will be timed with the Indian elections in May. So I expect the volatility to continue the next 3 to 6 months, but I think the bulk of the price risk is out of the system. So I see a favorable risk-reward environment for investing in small and mid caps from a one-year perspective.
Neelkanth, how convinced are you, or sure are you, of the sustainability of the India rally?
I don't expect, I've never expected that the Indian headline markets will correct very badly. I don't think we should expect that even in the next 12 months. I mean, there could be time correction at best, but I have not been in the camp that we should see like a substantial downward adjustment. That may happen. I mean, nothing is impossible. It's the market after all. What may happen is, if there's some accident, another accident happens in say, the non-banking finance space, and that triggers a whole lot of questions about interlinkages between, say, banks and NBFCs and real estate and mutual funds, and so all of those questions starting to get raised, and that raises questions on basically basic trust issues. I mean, who can you give money to, and who can you expect money back from? Those are issues which can drive a sharp leg down. Otherwise, I think fundamentally there is no reason why the market should have corrected very badly. I'll repeat that, I think no one buys the Nifty. So getting excited about Nifty doing very well is actually not the smartest thing to do. I think it's much more prudent to focus on which sectors should one be focused on, which stocks should one be focused on.
Right. Amitabh, in the year gone by, the market has given you enough and many opportunities for some right buys as well. I mean, 2017, the concern was valuation, right? But 2018, you couldn't complain of that, at least in some concentrated pockets. So tell me, what is it that you've bought recently and what interests you in the market right now?
I have not done too much lately. Been a little bit on the sidelines. Still holding on to reasonably high cash levels as I expect volatility and consolidation to continue the next few months. However, as and when opportunities present themselves or one comes across something which looks relatively safe, I'm happy to sort of bite the bullet. So one such opportunity recently I thought was in the CPSE ETF. When I looked at the components of the ETF, they were all attractively priced, both in terms of price action, they were all at multi-year lows, as well as valuations at almost half of the market PE. So low PE ratio, single digit kind of average PE ratios, high dividend yields, and businesses which are relatively stable, like companies like NTPC, Bharat Electronics, Coal India or IOC, one can argue have fairly stable business models which without too much threat of disruption going forward. Some are monopolies or monopolistic. The reason they are probably at these levels is due to the irrational selling by the government, who's the promoter, and repeated follow-on offerings. But hopefully over a year's time, once the disinvestment targets are met, these companies should revert to their mean, and therefore investors in these companies as well as the ETF, which was offered at a discount, should make reasonable returns.
Okay, gentlemen, stay with us. We're going to slip into a very short break. Before the break, we analyzed 2018. What were the individual stocks and sectors which were looking lucrative and attractive? When we come back, we'll find out from our experts what worries them about 2019 and how 2019 is likely to pan out. What one is seeing in today's market is that one is beginning to question consumption. And valuations aside, if I look at individual pockets like, say, suppose autos for that matter, the monthly trends of sales seem to be indicating that there is a concern of a slowdown within the sector. Sales are degrowing. You've got Maruti, which has recently actually downgraded its sales target for 2018 to 8%. What is your sense on how 2019 one should approach consumption, and would you be on the back foot?
I think they have already peaked. Some of the leading edge stocks have actually corrected quite a bit from their peaks, and that's very welcome, I thought. I mean, 5 years back we thought 13-14 times was the peak for an automaker, because it is after all a very capex heavy cyclical. But there was this phase where at 25-30 times PE, people thought that, oh, it's a consumer discretionary stock and it can keep doing well. Well, I mean, you can't just move from so when you're selling a car, it's not like selling a washing machine or a mixer grinder. So clearly some of the correction that has happened is I think very welcome. I don't think we are fully done yet for two reasons. The first is that I think the PE multiple is still too high. And these are classic cyclicals. Globally, automakers trade at, well, I'm not saying we should be going there, but 6 to 8 times. 20 times seems very high. I think 14, 15, given the higher growth expectations in India, may be more fair. The second thing is that, and this is a cycle which I'm surprised hasn't been sort of commented on more often. Maybe it happens once every 10 years, so every time there are people who discover it for the first time, and then in the next cycle they are not there again. This is the pay commission. I think the pay commission affects the salaries and pensions for almost 3 crore people. The total increase in payout at an annual level is 4.5 lakh crores. There is a much greater propensity to spend it. See, unlike say in the private sector, where you don't really expect a lot of sustainability in your bonus. I mean, it's very, very unpredictable to start with, and you don't really expect when you're going to get a big fat bonus. In the PSU space, there are two aspects that make it very, very potent for consumption. The first is that it's expected. 1st Jan 2016 is when the new pay commission is due, and your state government or your central government, even if it's late, it'll do it by 2018-19. So the Maharashtra is the last one is doing it from 1st January. So you know it's coming, so you've prepared for it. Secondly, you can assume this will be there till the rest of your life, and that affects the impact of this in consumption is massive. But the suddenness with which it starts is also is very similar to the suddenness with which it stops. So suddenly it seems that there has been a very sharp slowdown in demand, and you see the 5th pay commission, the 6th pay commission, around that time there was a big spike in demand and then it corrected. So I think both those factors are what keep us cautious on the discretionary stocks, including autos.
Right. And Amitabh, since we're on the subject of elections, 2018 also saw elections go by in 3 states, which were completely against what the markets would have liked. Irrespective of that, the markets actually rose up. Would you say that elections as an event and their bearing on the market is a little overrated?
Yeah, clearly going by this month's price action, it seems like the recent setback was well absorbed, and it also reminds us that politics matter much less than what we think or believe. And maybe it's also a harbinger of things to come for the general elections. Maybe that markets will place less importance on that than they have last few months, and hopefully it'll make our lives easier if they do so.
So Amitabh, how is it that you're approaching the low oil environment and low valuations as well for the mid and small cap end of the market?
The crash in oil prices makes India macro trade really attractive. Apart from the obvious plays which have already done well, like the oil marketing companies or the airlines, there are a lot of derived plays out there, and which are beneficiaries of a lower oil price. A lot of companies and sectors are have input costs which are a derivative of the oil prices, let's say the paints industries or others. Of course, markets are very quick to react, so most of these stocks, which are the obvious beneficiaries, have all moved up very sharply. And so one has to keep looking for maybe some second level thinking opportunities where there could be potentially auto should revive the cost of ownership, which should come down now with lower oil prices. Maybe certain other cement used to had costs associated with which got hit due to high oil prices, and cement could be another potential beneficiary sector.
Amitabh, you rightly called the NBFC crisis in 2018, and what a great call it's turned out to be. But what are the things that worry you about 2019 and the unknowns that the year coming up could throw up?
I still think we're not completely out of the woods as far as the shakeout in NBFCs is concerned. We seem to have somewhat hit a bottom for now, but in India there's always surprises in store for us. So we don't know what disclosures are yet to be made by certain banks or NBFCs, and clearly what the last few months has done is separated the men from the boys, and there are a lot of smaller NBFCs who are still, the confidence has shaken. It has sort of exposed the chinks in the armor, and I won't be too confident still about just going in and betting on some of the lower quality names at the moment.
Okay, on that note, we're going to wind it up on this edition of this very special show on what 2019 is going to look like for equity markets. Gentlemen, great to have you on the show. Neelkant as well as Amitabh here is wishing you a very happy new year from all of us at ED Now.
Thanks. Thank you very much for having me on your show.